Hello, my name is Dr. George Mochocki, and welcome to Corporate Finance Management 218. We're going to be covering Chapter 6 on bonds. Okay, so here's what you already have my concept maps. You'll make sure you utilize the publisher's book and the homework assignments you have, my finance lab by Pearson, everything. You'll understand the mechanics of it, the math portion. But what this quick lecture is going to be talking about the overview, the conceptual area that I'm going to be discussing, in which we discuss inside our discussion board or online. All right, so here we go, Chapter 6. I'm going to make this a little bit quicker. Open up your concept maps. And those who never heard me before, just for some reason, bonds was interesting, and you're listening to this lecture, I don't edit it. As I say it, it goes through, good or bad. That's how I get a lot of these recordings up and out. Okay, so I'm just gonna make this a little bit larger. I'm gonna put this at 200. Okay, that should be big enough where you could see it on your smartphone. Okay, because you could as an MP3. Let's see if I can make it a little bit even bigger. Let's see what 300 does. Okay, let's look at it this way. This is easier. You're going to have my picture here at the bottom. What's this chapter about? This chapter we're going to talk about, for lack of a better word, bonds and bond valuation, the value of bonds rating, what's a good bond, what's a junk bond, inflation and interest rates. We talked a little bit about that last chapter in chapter 5 about interest rates. We're going to talk about the different types of bonds and about the bond markets. Remember, the bond market is the stepchild of the stock market. We'll be talking a few chapters down the road. Okay, and detriments of bond yield. Remember, bond yield after I either issue a bond and I get my interest back, or I buy a bond to get interest back. The bond yields is all the costs, the hidden costs. After everything's done, the yields are basically a farmer's term. After I planted the seeds, put it harvest, brought everything else. What money do I have left? My profits. All right. After I paid for everything, that's what a yield is. Do I invest in a bond? Right now, I think the bond prices are like about 2%. I mean, look at the global economic news. You can look it up. Overall, 2%. 2% on my interest. It's better off I could go into a bank on that. So a lot of people, instead of issuing, remember, we talked about why would I could buy bonds to get a stream of income coming in. You're right. They're going to pay me quarterly the interest on the bond that I purchased to me. Okay, because I bought the bond, I'm investing my money instead of buying a new product or investing in a stock. So now it's going to have that interest, that stream of income is coming in. All right. The other thing is, do I want to take a loan out with a bank? Bank wants 6%. Hey, if someone will take my bond, my IOU at 2%, I'm saving money. So I then basically issue bonds because I got good credit. Right, instead of doing equity financing is basically selling shares. So I issue a bond, and people say, "Here's the money, George," or GAM Consulting, or whoever, or U.S. government. Here's the money, and you pay us so much interest back. So you're going to pay me interest back. Now, if at 2% interest, that's not really much. I could put in a savings account, now account, or a CD. I may make 2% of it. Why take the gamble with a bond? Now, bond basically, when the company becomes insolvent, bond holders get paid first. May not get the full amount, but they may get 50 cents on a dollar, 75 cents on a dollar, whatever. Stockholders or owners, they don't get anything unless there's something left over, especially if a company goes insolvent or bankruptcy. So there's some protection, which we're going to talk about, some terms and conditions. This one's going to be a little bit longer than my 20 minutes. I'm going to try to keep it underneath a half an hour. We discussed this in class. You did the readings. You did the homework. I just want you to see, get the overall picture. So what's happening in the bond market, since the bonds are so low, and the interest rate, the Federal Reserve, we're going to talk about that later on, is bringing the interest rates down for 2%. Why would I go in a bond market? Hey, I get a 2% return on my investment, maybe 1.5% after everything. I pay the taxes and everything else because there's income. It may not be worth it. So you see people, instead of investing in bonds, they're investing in commodities. One of the commodities they're investing in is gold. Gold has a value, right? I buy a dollar's worth of gold, and in 2 years, hopefully the price of gold goes up 5, 6, 7%. That's my return on my investment after I pay whatever I do on my tax, everything else. So I may get 4%. So why invest in a bond? Okay, remember, different streams of income. And a lot of businesses diversify. They got stocks, they got bonds, they got gold, they got commodities. They do everything else to get different streams of income to kind of look at what's going on in the economy. There's not one instrument that's going to be 100% secure. Anything could happen, but now I diversify. So maybe the stock market goes down, but the bond market's all right. The bond market goes down, the stock market goes down. Gold prices is usually kind of stable. They don't really drop past their face value, for lack of it, unless someplace in California they find a whole bunch of gold, and all of a sudden it's flooded with gold. The other thing you should be looking at now, if you're looking in bonds or anything else, is companies that are basically looking at rare metals because of the trade with China. When I talked about the Trump administration, whether you like Trump or not, I could care less. It's basically what's his policy doing from a business perspective, and how do I do management, risk management? How do I hedge to my favor so no matter what happens, I could do well on that? Rare metals. So if I know a company that wants a bond, they're going to be exploring rare metals. That's the things they use in computers, chips, everything else. Name it, the catalytic converter, rare metal. Now, if that company needs money, even though they're asking for a bond of 2%, I may say, hey, that's still a good investment on that. Or I may be a bonder or a stock, buy stocks in that company. I'm trying to offset it. Remember, I diversified my portfolio. When we talk about securities, it's bonds and stocks. Okay, so you got that. Okay, so now let's go. I talked a little bit about this yield to maturity. Yield to maturity is a rate implied by the current bond prices. If you have a financial calculator, and this we talked about, remember we talked about the financial calculator. My BizLab has a financial calculator. You plug the numbers in, and it tells you how to set it up. That's all this tells you. Now remember, now bonds is a debt. It's not an ownership interest. Creditors do not have voting rights. That's why, there's a bill. I need money. How do I expand my business, or how do I maintain my business? So I take a bond, an IOU. I issue a bond. Interest is considered cost of doing business, and it's taxable, tax deductible. Right now, it's tax deductible. Again, the Trump administration is trying to bring the corporate and the American thing out of debt. We owe everybody. When you look at our national debt thing, the clock keeps on going higher and higher because of interest. So he is trying, the administration is trying to bring us into more of an equity type of a financing. So right now it's tax deductible. Will it be tax deductible in the future? We don't know. So I'm kind of, I balance. If it's not tax deductible, I still get the interest, but I got to pay the interest. So if I get 4% or 2% interest, and I got to pay my taxes, and I'm in that higher tax bracket or corporate tax bracket, I may only get 1%. It may not be a feasible option. But right now, everything's okay. So I have to look at my terms and conditions. How do I sell my bonds or get out of the bond market? What are my terms and conditions? How do I return the bond back to the issuer? Terms and condition, all finance. Remember, there's no set. It depends on the risk. When I do an IOU, it's like a credit card. They'll give you credit card. I could have a 800 credit score, a real good credit score, right? So I could get it for 2%. You have a poor credit score, maybe 400, 500. You're a real high risk. Sure, we'll give you credit, but at 20%. Do you see what I mean? So the bond markets or IOU depends on the company. Also, we're looking at more the higher companies when they're looking general over what the bond prices are. But you could get some bond interest rates higher, but you have a higher risk involved. Okay, do not have a legal resource of interest or principal payments are missed. Remember, you don't have it. I don't have the money. All right, the legal recourse. Excess debt can lead to financial distress and bankruptcy. When we're looking at what do you call it, debt to equity ratio. This is something that we talked about accounting. I'm just touching on. I'm trying to keep this under 20 minutes. Okay, what's equity? Equity is ownership and interest, common stock, vote for the board. Dividends are not considered a cost of doing business, and they are not tax deductible. I have to pay this double taxation we talked before. Dividends are not liable for of the firm, and the stockholders have no legal recourse if dividends ain't paid, unless you have preferred stock. We'll talk about that later. I'm just throwing this in now. All equity firm can do is all in equity. Let me just get rid of this. Doesn't sound right. Sorry. Let me go back. Remember, I'm live. Let me go back, and then I just got to come in here. All equity firms cannot go bankrupt. Okay, remember the terms and condition. Okay, what's a bond indenture? Contract between the company and the bondholders, which includes basic terms of the bond, Okay, let me just go in here. Right? Okay, hang on a second. Expand format. I'm trying to do this so I don't have to do this later on. All right. Okay. So let me go to the basic terms of the bond. Right. That's the contract. Total amount the bond is issued. Description of property used as security if applicable. You have secured bonds and then unsecured bonds. You have sinking fund provision. That means how much money I put away to pay off my debt. This is what a company does. You have call provisions. If, let's say, I issued a bond of 16%, and now my credit rating and my bond is good, I could call it back from the person that issued a bond and say, hey, here's your $20,000. If you want another IOU with me, it's only going to be at 5%. It's almost like refinancing your mortgage. Okay, details are a protective covenant. Okay, so there's all this is terms and conditions, right? I'm not going to go into that now. I'm just going to move along. I'm watching the clock. I'm taking a little longer. Okay. Now, what are some bond characteristics? Remember, there's a lot on the bonds. And same thing we're going to do with the stocks. Down the road, it's going to be a lot. Bond characteristics. Okay, the coupon rate depends on the risks of the bond when issued. We talked about that, just like in a credit rating. I got a higher risk because of the company. The investors say, "Hey, we'll borrow you the money, but at a higher interest rate." Which bonds will have a higher coupon? All else is equal. Secure debt versus debenture bond. One has some collateral, one doesn't. Remember, when I do a line of credit on my mortgage, I have the house as a collateral. If I do my credit card, I have just my good word and my my the company's the value, my reputation, for lack of better words, that it will pay back. A bond with a sinking fund versus without. A sinking fund bond basically means I'm always putting money away to pay my interest rates or what I owe. I don't have to have it. I could say, hey, some people put money away to pay their credit cards. Other people say, hey, what the heck? When the bill comes, I'll pay it if I have the money. Callable bond versus non-callable. We talked about a little bit on that already. Bond ratings. Okay, here are the bond ratings. Low rating, Moody's BA, B, CAA, and CA. Consider the bond ratings. They keep on going down, down, down. Consider speculative with respect to capacity. A B rating are the lowest degree of speculations. Very low grade Moody's C, and Standard & Poor S&P. C income bonds with no interest bearing. Oops, let me move this over. Remember, this is just a review. Look it up in the book because I'm trying to keep this under. I'm not doing a full lecture. You could do a full lecture in all of them. This is just what was covered in the chapters. Moody's D is in default. Okay? All right. So now it's a bond coupon. Let me go back in here. I think I may just make this back to the 200. Seems like 300 is just a bit too big. Okay. You could just put your screen out. Make it larger on your end. Okay, what's a zero coupon? Make no periodic interest rate. Zero coupons, I owe the money. When it's end, I pay you out. The entire yield of maturity comes from the difference between the purchase price and the par value. Cannot sell more than for the par value. Par value is on the face of that bond. Sometimes called zeros, deep discounts, or original issue discounts, OIDs. Okay, Treasury, principal, Treasury stripes are a good example. Treasury bonds are good examples. Okay. Look, when I put a treasury bond, I give my grandson a bond for $500. Ooh, Grandpa, you're just the best thing in the world. But I only maybe paid $200. But after 20 years, it'll be up there. So zero coupon. You don't get nothing at the end. You get it when you cash in at the end. Okay. Other types of bonds you have is disaster bonds, income bonds, convertible bonds. Convertible bonds, I could convert them back to stocks in the future. It depends what the terms and conditions are. Do I, as the issuer, convert them, or do you convert them as the purchaser? All right. And disaster bonds, in case something would happen, I have money to protect, only in case of a disaster. Okay. Okay. Clean versus dirty. Clean is the quoted price. Dirty price, actual price paid. Quoted price plus the accrued interest. Okay, so that's a dirty price. Tells me everything about it. Clean is just what I paid for my quoted price. Okay, now the yield. Yield curve, still not big enough. I'll have to make this larger. Zoom out. If you, oops, sorry. I'm trying to get this just right so you could Oops, going the wrong way. Sorry. Zoom in. You zoom in. Let me just go in here. I'll go back to my 300. Okay. Uh, I'm talking to myself. As long as I don't answer myself, I'm good. Okay. So the yield curve, graphical representation of the term of the structure, normal upward slope. Remember, long-term yields are higher than short-term yields. Long-term yields over time, because the economy is fluctuation, and at the end I'll do better. Short-term, I'm looking just in maybe a 2 or 3 years period. Inverted downward slope, long-term yields are lower than short-term yields. Okay, because look, when you're looking at when I'm looking at long-term yields are lower than short-term yields. Look, if I got a bond for 5 years, 10 years, yeah, let's go 5 years. No one does it. Well, you could do 10 years, but it's a big gamble. Let's say 5 years. In 2 years, that whole thing could change. Remember, because it's forces, environmental forces that are affecting the economy has an effect on what the bond the interest rate, or not the interest rate, the inflation that could do. I may get that money at the year end, nothing change with the bond. Here's how much I get it. So I get 20,000 at the year end on $1 million bond. I'm just making the numbers up. So that 20,000, oh, I got $20,000 in 5 years. That's good. But the inflation ain't that up. The $20,000 may be able to only purchase something for maybe $5,000, $10,000. You see how it, even though I got the money, the value of the money, the marketable value of the money is lower because of inflation rate eats it up. A shorter term, I already know, hey, in the next year the inflation's kind of locked up pretty good. I should be all right for the next year or so. Okay? Moving along here. Okay, and then we talked about here again. We're talking about here. I'm going to move this over here because I'm at this end, and let's move it over here up higher. Okay, inflation versus and we talked about interest rate, real rate of interest, change in purchasing power. That's the word I was trying to find, purchasing power. What does that buy? What could I buy with the same amount of money 15 years from now that I could buy now? And those are decisions that businesses have to make when they're looking at streams of income, when they're looking at money coming in. Do I have enough to kind of offset if anything happens? A lot of people retire, but they're still working part-time. Why are they working part-time? To take care of that inflation rate. I get money coming in, takes care of most of my thing, but inflation comes up, my money is stable, like a bond. My retirement is flat. So how do I do the extra stuff to offset that the additional cost, that the purchasing power, that the dollar doesn't buy me as much as it would back 5 years or 10 years ago? Nominal rate of interest, quoted rate of interest, and we talked about that last thing, change in purchasing power and inflation. The nominal rate of interest includes all our desired real rate of return plus the adjustment for the expected inflation. Okay, now let's look at the bond market. Primarily, over-the-counter transaction with dealers connected electronically, extremely large number of bond issues, but generally lower daily volume as a single issue. I should clean this all up. Makes getting up to date prices difficult, particularly in small company and municipal issues. Remember, the bond is affected what's going on with the organization. You remember one thing you have to understand with the bond market and the stock market. Stock market, we talk about secondary market. Same thing with bonds. I got a bond for 16%. I purchased for somebody else, but I need the cash so I could sell it to on the secondary market, just like you do on the stock, for 13%. So I need, right? And you're looking here. I'm buying it at 13% from me, but the person who the bond is tied to that has to pay me that money back is basically still has to pay me 16%. So I'm making a profit. I'm getting rid of my bond because I sold it to somebody else in the secondary market at 13%. I brought it 13%, but I'm getting three. I'm getting the 16%, but I'm getting three extra percentage, and I would be able to if I went out and bought that bond from that individual because I got a better deal on that. Extra money coming in. Not that hard of a concept. Okay, floating bond rate. Let's look at floating bond rate. Coupon rate floats depending on the index value. Examples, adjustable mortgage rates and inflation linked to treasury. Remember the treasury bonds? It's something that I'm looking at. There's less price risk with floating bond rates because it adjusts what's going on in the economy. It good for me as a purchase who purchased a bond is not that good for the purchase the person who has to pay basically took the loan out and it's my bond and I needed the money like on a mortgage. Remember adjustable mortgage? It was good. People say, hey, it's adjustable. Look, the interest rates were low and all of a sudden they shot up and people couldn't pay the payment because they figured their wages didn't catch up to what the interest rates went in. Okay, I'm just trying to find something so you could kind of understand that, and we discussed that in the class a little bit easier. Okay, okay. Coupons may have a collar. A rate cannot go above a specific ceiling or below a specific floor. So it has a limit. Even an adjustable mortgage rate, you're not going to go up to 100%. They may have a cap and say, okay, right now it's 5%. It's only going to max up at 18%, whatever. And you're going to say, okay, that's something you have to look. You need the money. They want the money. It's a risk. They want. Remember the terms and condition. The borrower says, "Here's what I mean." The issuer says, "Here's what I want if you want my money." Or you could sell parts of the business or anything else. Remember, bonds are if I want to improve the business, maintain my business, or do I have the money, or do I have equity to sell something to turn it over to cash, or how do I take a loan, traditional loan from a bank, or do I issue my own IOU bonds? Okay, okay. Now, government bonds again, federal government, Treasury securities, T bills, T notes, bonds, coupons, greater than 10 years, greater than 1 year, debt of the state and local government, municipal securities. Remember, people say municipal security and government are secured. Detroit went bankrupt. People lost money even on the bonds on that. Okay, so what happened? It could happen. It could happen all the time. No, it's a rare issue. Could the U.S. Treasury notes default? We owe everybody. We're in a debtor nation. We already went number third. I think we're not doing too good. But our economy is strong. Our people still trust our economy with the GPA, gross national product. The GNP, gross national product, or GDP, gross domestic product. Gross national product includes foreign investment, gross domestic product, just as the U.S. as a whole. We still making stuff. I mean, we weren't. All of a sudden our debt or bonds are going bad back. But now, whether you like it or not, the Trump administration is bringing back manufacturing, bringing back. We're actually making stuff. If you all a service company, I could get service from another country. Somebody else could be a service provider. If I'm making a product, that's where China's kind of a little strong. They make a lot of products, so their gross domestic product is all right. The problem is that China sells majority of their goods, about 70%, to the U.S. We, as we're a consumer nation. Now, if we don't buy from China, okay, prices are a little high. We would buy from other countries. So where you're looking at China, their economy is a little bit more very strong than us through this trade war, whether you like it or not. I'm just showing this stuff. Think about it. Look it up on YouTube. Look at other things. Start reading about it. You have to be understanding what's going on in the environment and the economy, not only domestically, but internationally. What's the effect and the side effects on this? Okay, bond rating. Okay, let's go bond rating. High bond rating, AAA. This is not the auto. If you get your uh, AAA, okay, just basically is the highest rating you could do. Moody's AA or AA capacity to pay is very strong. Medium grade, basically capacity is strong, but more susceptible to change in the circumstances. Depends what's going on. Oil industries on their. If I look at technology, because right now I'm doing well. If I look at what's happening with Google. Google, look what's happening because they've got the antitrusting. So all of a sudden the ratings, not only for the stock but everything else, is dropping down because investors are going, hey, if they put this in, we may not make the money. They may have to pay a big fine. They may not be able as profitable as they are. You have to be aware. Do I pull it out? No, but I wait. Do I invest more? No. Do I wait? So, or do I sell? Remember, that's the whole thing in securities. When do I buy? When do I sell? Okay, Moody's and the Standards and Poor's, they're just index funds that you're looking at. BB, capacity to pay, is adequate. Adverse conditions may have more impact on the firm's ability. When you're looking at adverse conditions, it could be internal to the company, it could be technology, or it could be environmental forces. I'm buying some international bonds, and they're going through a revolution. Problem. Right now, what's happening in our bond? We're still stable, but what's going on with our with impeachment and all this stuff? It's not helping our financial status. Because people go, what's going on with the U.S.? Just a general, right? But we're still fairly stable. We always kind of make it through everything else. That's the thing about the United States government. We're very rigid, and we could do a lot of things and get away with a lot of things because that's just the way our Constitution and the way our democracy is set up versus a socialist country. Look what happened in Venezuela. Strong oil went down. All of a sudden, Venezuela is at the bottom. I mean, no one wants to invest in there. Inflation is rapid, like in the thousands. It's not worth it. People are staying away. You have a lot of discourse until something happens, and you can see that the economy is doing better, and then maybe the bonds go back. Now, what happened? The other bonds, they're already a default on the payment, so people are losing money. I'm just saying, look at whether you like our democracy or not, it's still very strong. The market, remember, the market, when it gets rid of companies through the environmental, is cleansing thing. That's what the free market does. If you can't make money, if you can't do anything, it's time for you to go up. Or if you look at certain countries, strictly socialist or communist, is they're controlling it. So if it doesn't work well, what are you going to do? There's nothing to clear out. It's the government trying to let's make the adjustment. That's what China's doing a lot of manipulating. And then manipulation, do you have the real value of the yen? Because when it drops down lower than the U.S., that means the U.S. products are higher. If their value is higher in the free market, is higher than the U.S. dollar. Okay, why buy Chinese? I'll buy American products. American products got the quality, blah 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 blah. So the China is manipulation. I'm just trying to throw some of this in. All this is inclusive in when you're looking at who I buy my treasury notes from, who I invest with, what I invest with. All these things are forces. 5 years ago, who would think we'd have a trade war with China? You don't know. Same thing was happening again with Mexico. Companies coming to Mexico unless they resolved the trade differences, and I think they came to some kind of a conclusion because Mexico is not a buyer of our product, but is a supplier of our products also, and it's one of the same hemispheres. Same thing with Canada. Okay, bond classification, security, collateral. Mortgage is secured by your house. Debentures unsecured like a credit card. Notes unsecured debt with an original maturity less than 10 years in seniority. Okay? Interest rate, price risk, and I think we covered that in interest rates, but I'll go over there. Price risk, change in price due to changes in interest rates. Low coupon bonds have more price risk than high coupon rate bonds because I could sell them on the second market. Low ones, what are they going to do? Can't go any lower. What I'm going to do? I'm stuck with this person unless I have a callable option. Reinvestment risk, okay. Uncertainty concerning rates at which cash flows can be reinvested. Remember, I'm taking the money coming back from the bond, and how do I reinvest that? It's stream of income we talked about last in chapter 5. Short term, more reinvestment rate risk than long term. Long term, I have longer because the system will basically level out. You got your highs, low, but overall, over a longer period of time, it should be equal, or at least to what I think it is, or not equal, level. Okay, high coupon rate bonds have more investment rate risk than low coupon rate bonds. We talked about that earlier already. Okay, all right. So what do we have here? Bond prices. Okay, a yield to maturity, coupon rate, then par value of the bond, yield, coupon rate, then par value to bond, selling a discount. Read that. We discussed that. I don't want to go too much. Present value of a cash. We talked about that again, and this is just the mechanics of that bond. Present value of coupons plus present value of par. Equals, and it just gives you that. Remember, in interest rates increase, present value decrease. So interest rates increase, the bond prices decrease, vice versa. Okay, and the last one, bond definition. What's a bond? Par value, face value. Coupon rate is how much I'm paying back to somebody else. Maturity date, when do I collect my full money back? And yield to maturity. Whew. Well, I think I went a little further than I wanted, a little longer. Remember, they try to keep me underneath a half, 20 minutes. This one's going to be a half an hour. Okay, let me just bring it back down. Format topic, expand, back to level 1, and view. And we covered a lot today, class. Fit to map. Okay? Look at everything we talked about. Now, I just give you a quick overview. So you have your concepts, you have everything else when you're doing the major paper for me. These are the terms and conditions, the terms I want to be included in your major paper. Whether you're writing a paper for myself or for somebody else, that's your major project. You're going to take a company and how you're going to turn that company around. You're going to do a hypothetical, a pro forma, you're going to do a financial business statements and everything else. But in your write up, you have to use some of these concepts. Okay, so let's see how many minutes I have. Under a half an hour. Psh, all right. Again, my name is Dr. George Mochocki. This is Management 218, Chapter 6. I just covered the main areas. If it wasn't clear enough, or remember, I'm talking real quickly. I'm not reading off the script. So I'm just giving you information, areas to look at, areas to, again, we talked about in the class. You read about it. You did some homework assignment. You did some math assignment. So I'm kind of watering this concept, and eventually it's going to click. You may not get it all, but you at least know some of the terms. The ones you don't know, look it up in the definition, reread it. The author in my Biz Lab by Pearson basically has short YouTubes explaining the mechanics of it, and they also have other YouTubes showing different countries, different applications of bonds, and that's why I do the article reviews when the students bring the articles in the classroom, and they'll say, here's what Motorola's doing, here's what McDonald's doing, here's what Subway is losing money. Here's what they're doing by trying to get extra cash to improve their businesses. And now you could take these concepts and you could tie it in and you see real life applications. That's the only way you're going to learn. This is just all definition, really nice. So you're like an encyclopedia. How do I apply it? That's what I'm trying to do is application, application, application. I see something going on. What's going on? How do I apply it into my own business or my own investment portfolio? Again, thank you very much, and I'm done. And sign up for my class or other classes. This is Chapter 6 on bonds, Introduction to Finance, quick overview, very quick overview.